Engine died, work stopped, 2 months of cash gone because of one equipment choice.
Welcome to the Veteran Entrepreneur Network. I'm Cameron Burrell, Army engineer veteran, entrepreneur, fleet services operator, and business educator. We're here to help you make operational decisions that actually protect cash flow and growth.
In the next 10 minutes, I'll give you a cash-first playbook so you can decide whether to buy, lease, or rent equipment without guessing. You'll come away with a quick decision matrix, lender readiness signals, a real total cost walkthrough, and a 5-step checklist you can use today. Before you touch financing, match the gear to the job. Power, mobility, uptime. Those 3 filters decide what really matters. Ask concrete questions. Does the unit hit the required gallons per minute or PSI? Can it reach the site without escorts or special permits? If it breaks, how fast can you get it back online? Quick example. If your jobs are short and local, mobility beats top-end power every time. If you run long restoration shifts, uptime and serviceability leap to the top. Now, the acquisition options: buy, lease, loan, rent, subscription, and what they do to cash and control. Buying gives control and depreciation, but ties up capital. Leasing spreads the cash hit and can include service, but costs more long-term. Renting maximizes flexibility and lets you test, but becomes expensive if used long-term. Subscriptions sit between rent and lease, with predictable monthly costs and bundled service. Simple rule of thumb: if a unit will generate steady revenue for multiple years, and you can cover repairs without jeopardizing runway, buying is on the table. If demand is unproven or seasonal, rent or subscribe until utilization proves out. Lenders look for straightforward signals: clean financials, a 1-page plan showing how the equipment makes money, and a clear estimate of cash runway. Practically, that means recent bank statements, tax returns if available, and invoices or quotes showing revenue per job. Key ratios underwriters respect: months of cash runway, a current ratio above 1.0, and a coverage test. Can projected revenue cover payments plus a 10 to 20% buffer for maintenance and downtime? If the math is tight, favor leasing with maintenance or short-term rental. Total cost of ownership is the trap. Don't stop at purchase price. Add parts, scheduled service, unplanned repairs, fuel, insurance, and the cost of downtime. A $25,000 used unit that breaks often will cost more in real monthly terms than a $40,000 new unit with a warranty.
Build a TCO line sheet: purchase or rental payment, insurance, fuel, scheduled maintenance, expected unplanned repairs, and downtime cost, hours lost times crew rate plus lost revenue. Run that against conservative revenue per job, not optimistic calls.
Quick worked example. A 4-hour job pays $800. Fuel, about $60. Labor, $150. If a breakdown costs you the job, you lose $800 plus roughly $300 in delay and repair. Call that $1,100. Owning adds $350 per month in payments and $150 per month in average repairs. If you do 8 jobs a month, that ownership burden is roughly $62 per job in fixed equipment cost. A rental that runs $200 for that job immediately looks cheaper on low-volume months and protects cash runway. Run these exact inputs in the worksheet and see which path preserves 2 things: cash and the ability to take the next job. 3 scenarios I see every month: solo startup, 1 truck, 1 operator, rent first. Test demand. Capture utilization for 60 to 90 days. Growing 3-vehicle fleet. Buy the core units you rely on, lease or rent specialty rigs, and keep terms that preserve working capital. Seasonal contract partner. Rent or seasonal subscription. Avoid off-season storage and appreciation that kills margins. 5-step checklist you can run this afternoon. 1. Estimate TCO for buy, lease, and rent over 3 years. 2. Run a cash impact model showing monthly payment versus conservative revenue with a 15% maintenance buffer. 3. Vet vendors. Ask for service history, parts availability, and local support. 4. Test rental or demo units and time actual job runtime and fuel. 5. Prepare a funding packet, bank statements, invoices, and a one-page use of proceeds tying the equipment to revenue.
A practical habit. Add a downtime line to every estimate you give a client, even if you never bill it. If a machine fails, you'll already know how much you lose per hour and whether renting a backup is cheaper than repairing mid-job. That single number changes decisions fast.
One last caution. Owners love the fully loaded package until the payments and repairs come due. Buy to win jobs and scale. Add extras when profit pays for them, not when financing does.
Resources. The Equipment Decision Worksheet Blueprint. Free, walks you through TCO, downtime, and cash impact. There's a vendor vetting checklist and a funding readiness checklist to make your packet lender-friendly. Use them to make a defensible choice, not a hopeful one.
One simple next step. Pick a single job, plug real fuel, labor, and runtime into the worksheet, and compare 3 acquisition paths. That comparison tells you more than a salesperson's monthly payment pitch.
If this episode helped, download the free Equipment Decision Worksheet and Vendor Checklist at veteranentrepreneurnetwork.com/worksheet. Follow the podcast, leave a review, and share this with another owner-operator or veteran entrepreneur. If you want a scenario reviewed on the show, submit one equipment scenario by the end of the month, and I'll walk through a selection on the next episode.
This is the Veteran Entrepreneur Network. Keep building, keep learning, keep leading, keep moving forward. We'll see you on the next episode.